Good morning, everybody, and certainly a pleasure to be here in sunny Hobart on a beautiful winter's day. And today we're going to have a look at investment bond basics. What are investment bonds? We'll work through that in the presentation, but they're basically an investment structure that can be used in a number of ways to help clients meet their goals and objectives. But first, let's get to the important stuff. The information that I'm going to provide today is general information only. It hasn't taken into account your personal circumstances. So if you think something that you see in this presentation today will or could help you in your investment objectives, then it's important to seek the help of a qualified financial planner in this regard. Okay, so most of you or some of you may have already seen a financial planner previously. Now, the role of your financial advisor is not only to determine what strategy is best for you, what risk you're prepared to take with your investments, and what type of investments they should be using. They're also looking at what tax structure is best for you. So the tax structures we're all familiar with for most of us is, ordinary investment taxed at our marginal rate. We've got superannuation and account-based pensions or income stream investments, which are taxed very concessionally. But what we're going to talk about today is investment bonds, which are taxed at a maximum of 30 cents in the dollar. And we'll talk through that as we go through this presentation. Investment bonds in our world we see can be a cradle-to-grave strategy. So what does that mean? You can use an investment bond to accumulate wealth through savings. And then at a point in time where you decide that you need to use that money, you can either draw it out as a lump sum and spend it, or you can actually turn it into an income stream. And then at the end of that, when you decide to depart this earth, investment bonds can provide some very effective estate planning processes for you and can actually help that transfer of wealth from you to your beneficiaries. So let's look at some of the basic information about investment bonds. So investment bonds are tax paid and they're capped at a maximum of 30 cents in the dollar. So most people are familiar with superannuation, which is taxed at a maximum of 15%. Investment bonds work very similar to that, but it's taxed at a maximum of 30. That tax rate can be reduced through the use of various tax credits, imputation credits and that type of thing that come from investing in the share market. Investment bonds have no formal contribution limit and there's no set investment period. You may have heard them referred to previously as 10-year bonds. Certainly, after 10 years, you do get some additional tax benefits through using an investment bond, but there's certainly no limit on how long or the length of time you need to hold that bond. They can also provide tax-effective income streams. Now, this is very important for people that might be looking to perhaps retire before their preservation age in super. You can actually use a bond to provide you with an income stream, and that may come with a non-assessable component and also an income component which carries a tax credit of 30 cents in the dollar. And there's no need to have a condition of release with investment bonds as there is in super. So most of us, to access our super, we actually need to be retired and out of the workforce, whereas with an investment bond you can turn on that income stream, access your capital at any time without having to worry about any of those other restrictions. They also have the potential to maximise some of those peripheral benefits. So for some of you out there, it may be that you want to receive the seniors healthcare card, but your income might be over the income test limit. Putting some money into an investment bond can reduce your adjusted taxable income and may allow you to re-qualify for something like the seniors healthcare card. Another thing that investment bonds offer that many people don't know is protection from bankruptcy. So just like super, if you've got money sitting in an investment bond and something goes wrong with your business and you have to declare bankruptcy, Well, we know that the bankruptcy trustee can't get hold of your super. They also can't get hold of your investment bond. If it's being used as part of your ongoing retirement strategy, that money is protected, but you still have access to it and have the ability to actually provide yourself with an income if you need, draw money out to meet living expenses without the bankruptcy trustee having a claim against it. The other important aspect of investment bonds is that they don't form part of an estate upon your death. So effectively they bypass the will. Now this can be very, very effective where there may be a claim against your estate and you want to ensure that particular beneficiaries, particular people who in your life receive the benefit and don't have to worry about that being claimed by someone outside of the family unit or even inside the family unit. And solicitors we work with have certainly long considered investment bonds as a very convenient way to disinherit people. So let's have a look at the bond structure. So you have a bond owner who can be a natural person, a trust or a company, and they have the ability to make all decisions, and you can have multiple owners. The life insured can be a natural person or must be a natural person of any age. You can have multiple lives insured. Once you've got a life insured on a policy though, it can't be removed, so you need to think carefully about how you structure that up. You can add other lives insured, and if you have two lives insured, it's the survivor that determines the end of the investment term. So you've got two lives insured, one person passes away, the bond will continue until that second life insured passes away. At that point, then the bond is paid out to either your beneficiaries or if you haven't nominated beneficiaries, it will go back to your estate at that point. Beneficiaries can be natural persons. They can be dependent or non-dependent, or it can actually be a trust. We see a lot of people these days leaving money to charitable organisations, whether it be the Red Cross, the Lost Dogs Home, you name it. Children's Hospital is another one where we see quite a number of bequests through investment bonds. And those people can receive the death benefit either as a lump sum or, in the case of our bond, we have what's called wealth preserver, where you can actually allocate funds to an individual to be paid as an income stream, not necessarily as a lump sum. And you can have multiple beneficiaries as well. The taxation on bonds. So I mentioned earlier that there is a 10-year period and sometimes bonds are being referred to as 10-year bonds. Well, the way it works is your bond is taxed along the way at no more than 30%. If you need to access your money in the first 10 years, there will be some income that you need to pay tax on. But that comes with a 30% tax offset to reduce that. So if your tax rate is 30% or less and you draw your money out in that first 10-year period, you actually won't pay any tax because the offset will take care of it. But there is also an allowance for the fact that when you're getting close to that 10-year period, there is a discount applied. So in the first 1 to 8 years, any earnings withdrawn from the bond are fully taxed with a 30% offset. In the 9th year, you only have to declare 2/3 of that income. And in the 10th year, 1/3. After 10 years, the 11th year, you can withdraw all proceeds without any additional tax. There's also no personal tax inside the bond upon switches. So if you want to move your money between the different fund options, from say a conservative option to a more growth option and back again as you get towards retirement, you're not going to create a personal capital gain tax. All of that is dealt with within the bond itself. You only have a personal tax liability upon withdrawal from the bond. And of course, as I mentioned, you pick up the 30% offset. We quite often get asked, what's the ideal person to use a bond? And that's a really difficult question because it's not so much a one-size-fits-all and there's not one particular person that's ideally suited to a bond. But we can probably break it down into 3 different areas where bonds can be very effective as part of your investment strategy. The first one is what we call ATI tax arbitrage, and that's really just reducing your real rate of tax and reducing your taxable income through investing in a bond. The other area is what we call super no-go. So we're talking about clients that either can't get into super because they've already hit their caps. It may be that they are too old to get into super, or in some cases, you might even consider too young to use super. The 25-year-old coming out of university that looks to set up a super fund might go, well, I don't really want to put all of my money into super because 60 for me is a long way away, and that's when I can get my super at the moment. And then there's the estate planning features, and that's the ability to use a bond to effectively distribute wealth outside of the will, and again, free up, I suppose, the estate from challenges in that regard. So our current strategy opportunities at the moment. So we talk about the super no-go clients, too young, too old, too much. So again, 25-year-old, too old, can't get into super because of the rules, or the too much. So there's been changes to super recently that have impacted on how much you can get into super. The lifetime cap of 1.6 million, the concessional, non-concessional caps. All of these things have made super a little bit more, I suppose, difficult to deal with for some people. So this is where bonds can help you there. The tax arbitrage we talked about before, about reducing your taxable income so that you're not paying as much tax, but also giving you access to some of those peripheral benefits like the seniors healthcare card. And there's also the estate planning and streamlined wealth transfer. Some of the other areas though, tax effective income stream is what we call a true transition to retirement. There has been some changes to super death benefits, particularly from retail super funds, with the abolition of anti-detriment payments, and that affects people that are passing on benefits from super to non-dependent adult children. So you need to be aware of some of those issues. We've got a strategy which talks about the first home buyer deposit. You know, some stats we saw from the Australian Bureau of Statistics told us that the average age of the first home buyer at the moment is about 38. So again, you're that young person coming out of uni at 25, potentially you've got 10 to 13 years before you're going to get yourself into the housing market. Now that's an Australia-wide statistic, but again, you know, it's not easy for people to get into the market. So we've got a strategy that looks at saving for a home loan deposit, and it's not about what their marginal tax rate is today. It's the marginal tax rate that young person has in 10 or 12 years, that if they were using a range of managed funds or direct equities, they're going to have a huge capital gain issue, where a bond helps remove that. Because in 10 or 12 years, when you want to access the money to get into the market, it's all tax paid and you haven't got that capital gain issue to worry about. Education funding is another area we play in, and also family trusts. Bonds can be used to help minimise tax from distributions of family trusts, and also used for some of the off-farm equalisation strategies where, you know, mum and dad have got the farm, one of the kids stays on the farm as working, the other two go off and work in the city, but they've still got a share of the farm to come to them, so there are strategies we can work around that. So I want to have a look at some case studies now, and this first one is really about investment bonds and super no-go. So for that client that can't get, you know, the amount of money that they want to get into super, there is no doubt that super should be the primary source of retirement savings. That if you're looking to save effectively for retirement, super clearly is the way to go. But we really need to start thinking about diversification. Our research shows that 46% of pre-retirees and retirees have no other investment outside of super. That's a fairly big number. So nearly half of us are relying just on super to meet our needs in retirement. Is that going to meet our needs in retirement, just using super? Well, interestingly, the government recently changed the definition of superannuation in the SIS Act. So the definition used to read, superannuation was designed to provide a benefit in retirement. The new definition, and this started ringing alarm bells for us, the new definition is superannuation is to be used to provide an income stream in retirement to supplement or replace the age pension. So for me, that definition tells me that it's somewhere down the track, there's a very high likelihood that superannuation is going to be an income stream only option. So building something outside of super is something we all need to have in the back of our minds and start thinking about seriously today. So here we've got Mike. Mike's 51, was self-employed for 12 years and recently sold his business and now back in full-time employment, earning about $100,000 a year. He was able to contribute money to super using the small business concessions, capital gains tax, small business concessions. And he had a surplus of $500,000 that he had just sitting in some term deposits. He invests his $500,000 in investment bond and he adds to $20,000 surplus income annually to that. His aim is to retire at 55, but he wants to also have access to money if he needs to. He also needs to pull out $600,000 upon retirement to clear a gearing debt. So he's got an investment property, he owes $600,000 on it, and he knows at some point he needs to clear that. He's going to continue to run that investment property and continue to pay out that debt interest only while he's still employed. But when he gets to retirement, he's got a $600,000 debt he's got to look at clearing. Okay, so we've assumed he's a growth investor and the return on the investment bond after tax and fees we've used here is 5.6%, which is an 8% return less than 30% tax. So that's where we get to that part there. So what's it look like when we fast forward to 2026 at age 59? So the bond has now grown to about $1 million. He draws out his $600,000 and his balance at the end of that year is $449. Now, given that he hasn't been in the bond for 10 years, he's got a taxable component of $211,000. But because he's getting closer to the 10-year period, he gets a discount on that. So the taxable amount of that is only $140,000 only. How good it would be to have only a tax liability of $140,000 or taxable income. Tax on that's around $39,000, but when we add the bond offset of 30%, you can see that that will wipe out his tax. So what Mike's been able to do is use a bond very effectively. It hasn't added to his year in, year out taxable income. He's been able to draw the money out before the 10-year period, and he's been able to then take that $600,000 net in his hand and clear his gearing debt. He then would look at what his other options are. He's got $400,000 left that he can use to provide an income until he reaches preservation age of 60 and can access his super. So this strategy for clients that can't get money into super but still have a need to probably go a little bit earlier in retirement can work quite effectively. Okay, so how does it help? Well, bonds aren't preserved like super. You can access it at any time, so that's good. If you hold it up until the 10th anniversary or even before that, you do have that tax offset that helps reduce the tax payable. No contribution tax using an investment bond, so that certainly helps. And there's been very little legislative change around bonds in the last 30 years. Whereas with superannuation, we're seeing changes every budget. If you're dealing with a financial advisor, they're pulling their hair out every budget night because, another change to super. And that makes it hard for you, the client, also to determine what's best for you. And this is where working closely with your financial advisor is going to help you keep up to date with those changes, but also help you understand what other strategic options are out there. Okay, our second case study we're going to have a look at today is estate planning and wealth transfer. But first, let's have a look at how we transfer wealth. Okay, so if you're in superannuation or you're in some sort of account-based pension, there's a trust deed that determines how the money is transferred if you were to pass away. With companies, if you've got a company structure, there's a constitution that will deal with that. Family trusts, again, there's a trust deed that deals with that. And with personal wealth, money in bank accounts, property, etc., again, it depends on whether or not you've got joint tenancy, tenants in common, or whether there's testamentary trusts in place to help determine how the wealth transfers from you to your beneficiaries. Something like $46 billion every year is transferred through estates. That's a huge number. And given that there's a lot of money being transferred from one generation to the next, investment bonds can be structured to be a non-estate asset. So I've got a little section of the Insurance Act there, but essentially what it says is that investment bonds do not form part of an estate where the owner has deceased. So again, an important aspect to consider where there may be claims against your estate. But let's have a look at a recent example where an investment bond was used very effectively. So we had a client several years ago, Ronald, who was a very wealthy man and had a considerable amount of cash sitting in an investment bond. He was concerned that there was going to be a claim against his estate, and so he set it up to ensure that there were 4 people he certainly wanted to benefit from the $21 million that he had sitting in the bond. He nominated 4 beneficiaries. 3 of them were his adult children. One of them was a grandchild with a disability. And he used the wealth preserver option in our bond to distribute this. And what does that mean? What happens is, upon his death, we created 4 new bonds, and each of those beneficiaries could then determine whether they just took the lump sum and ran with it, or they could actually keep it in the bond and continue the investment as an investment bond. So what each of the adult children did, which was Peter, John and Pauline, they actually chose to keep their bond. And in each case, they drew an income, differing levels. Peter, 120,000, John, 160, Pauline, 80,000. And each of them retained their senior healthcare card. So they've got $5 million sitting in an investment bond, and they're still getting government benefits through a healthcare card. No pension payments, but they're getting those benefits of the healthcare card. Malcolm received a smaller lump sum, and he's being paid an income stream of 4% of his account balance. So he's getting an income for the rest of his life. Now, if something happens to Malcolm and he passes away, whatever is in here will then go through to his estate. Okay? And he can also nominate beneficiaries off the back of this. So, but let's take a look at John. John's drawing $160,000 every year from his $5.25 million in the bond. How does that work? So, he's got his $5 million going in. His earnings after tax, around $250,000. He then draws his $160,000. Now, there's a tax office formula that's used to determine how much tax is payable on that withdrawal. So in this particular case, he only has $7,474 of taxable income in the first year from his $160,000. Even though you might think, well, he's earned $257,000, how is he not, paying a lot more tax? Well, again, it's just the tax office formula that works that. We then go to the next screen. He's got his rebate as well. He also has his low income rebate. He's got his senior age person tax offset that applies. So when we apply all of those, he's got his taxable income. He actually ends up with $160,000 and no tax to pay. Now, when we modelled this, we actually fast forwarded it out, and unfortunately, John does have a tax problem in year 8. And the tax problem is his taxable income is above the limit at the moment where he needs to submit a tax return, but his offsets still reduce his tax payable to 0. So he pays no tax, he just has to submit a tax return. Once he gets to year 9, because of the discounted income that has to be declared, he actually doesn't have to put in any more tax returns. And once he gets beyond the 10-year period, all income that he's drawing is tax paid and he has no tax liability on it. And he's got his healthcare card all the way through. All right, and our third and final case study looks at the adjusted taxable income tax arbitrage. So that's reducing somebody's taxable income to either bring them down to a lower tax rate or to allow them to qualify for some of those additional benefits. So it's a little bit like the seniors healthcare card. Now in this particular example, it's not about the best tax outcome. This is about somebody wanting to achieve a particular outcome and put tax to the side. And we get clients from time to time that think that way. So we've got Dot, 72-year-old widow. She just inherited $300,000 from her late mother's estate. She's already getting $45,000 in taxable income from a variety of sources. That could be from investments, it could be from pension payments, that type of thing. Currently got her money sitting in an online account, looking for advice. She considered a conservative managed fund or an investment bond. So you can either invest money in a tax structure in a bond or in an ordinary managed fund outside of any form of tax structure. Okay. She doesn't need any additional income over a 45, so this $300,000 is going to produce income she doesn't need to spend. But she does want access to the money if required. So we did a comparison looking at, well, what if she did invest in a managed fund outside of super and outside of an investment bond? Well, what's the investment bond look like? So we took a very conservative approach and we're in a managed fund which is providing about a 3% income return. And the bond, we're looking at 2.1 return after fees and taxes. So what actually happens here for Dot is her income goes up to about $54,000. And what that actually does, that takes her out of qualification for the seniors healthcare card. It puts her over the limit of income. She then has tax of $9,000 to pay on that. She has the low income rebate applicable, so she gets a $190 offset there. So her total tax payable is $8,900 over the year. If she was to use the investment bond, here's her picture. She's still got an income of $45,000 and tax payable on that is $6,172. Because her income is still quite low compared with the first example, she picks up a low income rebate. She also picks up the senior age person's tax offset. So her tax payable is $5,000 on her 45. The money sitting in the bond is still growing. She's still getting a return there, but it's compounding within the bond. And she retains her seniors healthcare card. So this was important to Dot in this scenario. If you looked at the tax position though, the tax inside the bond at 30 cents in the dollar is probably going to be higher than the tax she pays as an individual outside across the different marginal rates. But Dot's aim here was to retain the seniors healthcare card. And this is where a bond can help you in that regard. Okay, so again, just to highlight some of the strategic opportunities that are out there. Super no-go. Too young, too old, too much. We've talked about that. The tax arbitrage, we just talked about reducing your marginal tax rate or reducing your adjusted taxable income can allow you to access certain additional benefits. The estate planning, wealth transfer is another benefit of bonds. You've got the first home buyer strategy, death benefits from super, another one to consider, tax effective income, education funding, and of course family trust strategies. So they're all the strategies that are there. Not all of those strategies are going to suit every person. So it's important, if you feel that one of these strategies might work for you, go and talk to your qualified financial advisor, because they can work out for you where an investment bond might work. Are you a super no-go person? Have you got young children who are looking to fund education costs? Have you got estate planning issues you'd like to take care of? Have you got a tax problem right now that you'd like to reduce? Is there a family trust structure that a bond might be able to help you with reducing distributions from that? So thank you for today. What are the next steps from here? Well, if you feel that something we've mentioned today might be of benefit to you, certainly get in touch with your friendly TAS plan advisor. at one of their offices across Tasmania, and they will be able to sit down with you, take you through what options are, have a look at your current situation, look at what you're trying to achieve, what your goals and dreams are, and then they will come up with a strategy that may or may not include investment bonds. But it's worth having the conversation, and I'd like to thank you for your attention today.